But my first question is, what's the difference between a pre-approval and a pre-qualification?
So pre-approval is when we get all of the documents up front. Pre-approval is a much stronger offer than a pre-qualification. Pre-qualification, you're going to give me a couple of documents. Say you have 10 hours of overtime on that pay stub. I'm going to take it as gospel that you get 10 hours of overtime every single week because I'm not vetting anything. I'm not going through the extra verifications. So now I'm going to overqualify you. And if I overqualify you, now you're out of your budget. And the house that you really think you're going to buy, you're going to get to the closing table and realize you're never getting to the closing table.
Interesting. Yeah, no, Chris, I think you're good on that. I mean, I just had more of a scientific breakdown, of it, but I figured you'd be able to put it into layman's terms. That was good.
Yeah, very straightforward. I like that. What kind of things do you look for when you do a pre-approval versus a pre-qualification?
Consistency. Consistency is key. We want to make sure that overtime is being given out over multiple periods of time and over a 2-year period, that it stayed about the same. We're going to dig deep into the job history. We want to make sure that, you've had that employment for 2 years. Doesn't have to be at the same exact place, but you got to be in the same industry. And being in the same industry, when you move on to a new job, you have to show improvement somehow, either in hours that are more satisfying to you and your family, or in pay.
So what type of information is needed for pre-approval then?
So what we're going to need is we're going to need W-2s from the last 2 years. We're going to need 30 days of pay stubs. The 2 W-2s with the 30 days of pay stubs is going to show what you've done the last 2 years and what your current year to date is, and if you're on the same pace, doing better or doing worse. Also on top of that, we're going to want to see your bank statements for the last 2 months. Bank statements are really important because it shows us that you have the money so you could put it down and you can get to that closing table.
Awesome.
And in between the lines there, we're always trying to do like due diligence on it, where, if the borrower, like those will be your calls to us, Wally, right? Can the borrower afford this? Can we do this deal without the seller's concession? Does this work? There are so many, behind the scenes things that we do to separate, I guess, from that pre-qual to
full pre-approval.
Pre-approval, right? See, I was diagnosing a little bit more because everything really should just be a pre-approval, right? That borrower should know almost, 99.9% of the facts before they're actually looking at that house or making an offer, let's say, right? And a lot of people, they just think that, I can see this house now because I got a pre-approval or a pre-qual, and there's so much more to know about it. Like, what were the expenses before those people are leaving? Like, what's the electricity bill? Like the hot water heater? Like, how many people you think you're going to fit in a 1,000 square foot home or 3,000 square foot home or 5,000 square foot home? Like, those are real things to look at that homeowners don't understand. Holes in walls and paint and all that cosmetic stuff can be fixed. You got to think of the reality of having the ability to change an HVAC system or change a hot water heater, or maybe you go with a tankless water heater. But you know what? Do that up front too, right, Wally? Right. Listen, there's other ways and there's tricks of the trade, but the pre-qual should include all that. It should include a real intense conversation with the borrower, on their affordability.
What allows a buyer to get a higher pre-approval?
Lower taxes. Taxes are the biggest part of every single transaction. The lower the taxes, the more purchasing power you have. Your taxes are lowered by $200, you pretty much gain about $50,000 in purchase power to buy a home.
Wow. That's a big jump. How does credit impact pre-approval?
The credit's going to see what type of loan you're going to get. If you're going to have an FHA loan, your mortgage insurance is going to be on there. It's going to be on there for a much longer time. The better your credit is, the better off you're going with the conventional loan. With the conventional loan, you can get rid of the mortgage insurance in as little as a year and a half.
Chris, my advice is always, if you're not really putting down more than 20%, right, and you're just kind of like floating under that, my advice is always to put down the most minimum payment that you possibly can versus the most minimum amount of payment that you're going to get. So if you're kind of like a borderline client, just go with the minimum payment with the minimum amount of down. And then when you think about how to pay off your mortgage after you're the homeowner, right? That second run of refinancing or however else you could streamline it, I know a new product just came out, what is it, FHFA? So like, I think that there are going to be more and more products going that route, but at the end of the day, you can't think about how you're going to pay off the mortgage until you're actually in the house, right? And you don't want to take your money and put it to an asset that you can't get back, at least right away.
The way I like to explain it to some of the clients is I take that number at 20% and I take that number at 3%. And I subtract the two numbers together. For example's sake, say we're buying a $100,000 house, 3% is $3,000, 20% is $20,000. That's a $17,000 swing. Right. So what I'm going to do is I'm going to take that mortgage insurance payment and I'm going to divide it by that $17,000. And I'm going to see the cost effectiveness of holding the mortgage insurance as opposed to how many months it'll take you to recoup that $17,000 that you're probably going to need. You never know what's behind the walls when you buy a home. And a lot of people don't think about what can happen in the next 5 years. You get the inspection.
Sprinkler heads get caught.
The inspector says your roof is good for 5 years. What are you doing in 5 years?
Right.
How are you going to fix that?
Yeah.
How is that going to be affordable for you? Yeah, you got to hold some money back. You need to have some sort of nest egg. So when the mortgage money is cheap, max financing is always the way to go.
Okay. So do interest rates come into account during the pre-approval process, or because you just mentioned max financing when the mortgage is cheap, do interest rates come into account when we're doing the pre-approval?
I like to say interest rates are more of a marketing technique. You're not going to not buy a house over an interest rate. Your payment can fluctuate $50. If you're going to if you're crying over spilled milk over $50, maybe it's not the time to buy a house.
Yeah, or just drop in category. It was always common where rates were high, property values were kind of low, right? We're in a unique time where now rates are low and property values are so high that even if rates got higher, the property values, I believe, will still hold its value. What that does is it actually takes a certain person out of the concept of buying that house or that community. So like if rates go from, let's just say 3.25 to 4.25, that $200 swing on 500 grand, it does take people out of certain communities. All right. And that's really where we'll see those hits. But I don't believe we're really going to see them, guys like me, guys like you, Wally, only because there'll be another buyer for that house. So I think that getting into people's lives about that pre-approval and that pre-qual, scenario, can impact them in the right direction, educate them, motivate them, inform them. Listen, if you got $50,000 to put down on a house and you work remote, right? Maybe it's time to leave and go to a spot that you can maybe retire in 15 years rather than have it take a 30-year,
Right.
Or go where your mortgage payments can be $1,200 instead of $3,000, and that's where lower taxes are, right? It's harder to find, but that won't hurt somebody, man, when their mortgage payments are under $2,000, I think,
Right.
But, it's just hard right now where the market's at. There's not a whole lot of inventory, and, it's like people still, without them understanding, they may have a better option.
Sometimes when people are buying, they only want to see what the maximum they can borrow is. That's not always the best way to go about things. It is a long-term commitment. Most mortgages are 30-year term. That's 360 months. You need to be comfortable with that payment for 360 months. It's not always about you could borrow $500,000. It's, are you comfortable with this payment on $500,000?
Yeah, I often ask that same question. It's like, what number are you comfortable? And I say, all right, this sounds like a good number. Get in contact with a mortgage banker so you can kind of iron out those numbers, see where you are and how you're going to get there.
Exactly. Every client I talk to, I always take that extra step forward and I break it down to its littlest monthly payment.
So the person just
and I ask them if they're comfortable with it. And I'll ask them this 4 or 5 times throughout the process, because if they're not comfortable with that long-term investment, maybe we need to drop the price a little bit. Maybe we need to look in an area with a little less taxes.
Right. You mentioned earlier that the property taxes have a very large swing between the amount of taxes, like a $20 shift in taxes going down, and and the amount of creditworthiness our pre-approval can give. So when you're looking at how property taxes are accounted for in the process, how are they best described in, when you're talking about a pre-approval? How are they accounted for in the process?
So what I try to do first is I try to tie down a specific area where you're looking for. And then I figure out kind of what you qualify for at an overestimated tax rate. After I get that done, then I do my own backup information and I'll go to all these different websites and I'll check out the taxes for that price range and I'll see if I'm right or if I'm wrong. So I'll get a good consensus of the area and then I'll put in a tax number there. And that's how we'll work the pre-approval off of that number that I figured out after doing about a half hour of work, just checking out listings and pulling those tax numbers in and getting myself a nice, really good average of the area.
What other things do buyers need to know when they're talking about getting pre-approved and getting ready for that first step of buying a house?
They need to have their documents ready to go. The faster the documents are submitted, the faster we can qualify the income and the faster we can get the pre-approval out. So the documents are the most important part of the process because you can tell me anything you would like to tell me. You could tell me you make $1 million a month and this and that, but without the proof, I can't take it for anything. The documents are the most important part of the pre-approval process and making sure that they are current and that they are correct.
That's all the questions I have.
Awesome.
Anything I missed?
No, I think we're good.
All right. Well, thank you very much, Chris. Thank you, Darren, as well. That's all I got.
We did it. Yay, thank you. I'll go on and on and on though. I get into them,
I know.